What would you do with an extra 10 years in retirement? Stay tuned. Today, we're going to talk about ways you can retire early without running out of money.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just everything your financial advisor won't tell you.
I'm Casey Smith. Today, I'm joined with William Metcalf,
How's it going?
rock star, certified financial planner, and now a due designation. William,
That's right.
tell me about it.
Certified in blockchain and digital assets. So just did a course on that over the past few months. And we have another advisor here who also has that designation. It's just
Right.
a little bit more specialized, a little bit more knowledge on an area that I really didn't know about.
Yeah.
So
But now you're like the blockchain digital asset expert.
something like that.
Along with Andrew. Andrew's the other one that has that designation. I have actually everybody working on that. We have a few that are about to sit for the CFP, so that's their concentration right now. But that's something that I want all of our advisors to be experts at, is blockchain and digital assets. It's the way of the future. So congratulations for doing. That's two things this year: CFP and
That's right.
the designation's weird because it's like CBDA. CBDA. It makes me think of those stores on the side of the road, vape and.
Oh yeah, yeah, right, yeah.
I was like, I don't know if marketing.
No
thought
THC in this one. Yeah,
I don't know if marketing thought about this clearly. All right, well, let's start with a wiser stat. According with our topic today. So, according to a simulation by Morningstar Center for Retirement and Policy Studies, about 45% of Americans who retire at age 65 are projected to run out of money during retirement. For those retiring as early as 62, the risk climbs to about 54%. That data is for normal retirement age. I should say that. It highlights the magnitude of risk for early retirees. And honestly, we can break this down. Why do we think that 45% of Americans who retire at the age of 65 are going to run out of money? 54% at age 62. What is it for 55 or 50? Right.
Exactly. I mean, this just comes down to, like, most Americans, a lot of Americans, they just I don't think they know what it costs to retire. And I don't think they maybe even have a handle on what they're spending now.
Yeah.
And so if you have a bunch of different things going on, it's not clear to, maybe what you're spending. And if you don't know what you're spending, and then maybe you do some bad math that, gets you to the conclusion that you can retire, then it doesn't really work out very well. So obviously, if you retire early, that just magnifies that risk because it's just more years that you're not going to have income.
There was a time period where our local electric company, they had pensions. The pensions are still there, but they're smaller now for retirees. But back in the day, they were coming out with pretty big chunks of investments. And what I would see happen is there was no financial discipline. Here are people who they didn't have a college education. Not that that necessarily matters. It's,
right.
You can educate yourself on money outside of college. In fact, I don't know if college educates you about money,
No.
quite honestly.
No.
But they would receive, like, for example, a supervisor or a manager received like a $3 million pension. And this couple came to me and said, "Hey, I'm at this brokerage firm, and I think they've mishandled my money." And they had $300,000 in the account.
Mm-hmm.
And this brokerage firm is not known for good ethics. They talk a big game. We can get you 10% a year, And so these more uneducated investors would fall for that.
Right.
So I thought, oh my gosh, we got one. Like, we're gonna get an attorney and we're gonna bury this guy. So I said, well, bring me all your statements from the last 3 years. And I start pouring through all the statements. And it became very apparent that there were very large withdrawals. The only thing that the broker probably did wrong is they weren't withholding taxes. So they created a tax snowball. So if you take $300,000 out of an account and you don't withhold any tax, and you go back the next April and you pull that money out and you don't withhold tax, it creates a snowball.
Right.
And there was no tax planning being done because he's not a wealth advisor. He's a broker, right? Most of these places on all the street corners are brokers, not tax advisors, right? So that was an example of a person that should have had a great retirement couldn't handle a large account and ended
Yeah.
up living on Social Security 3 years into retirement. They went through almost $1 million a year,
Yeah.
which is insane, right?
Yeah.
So it's probably some mismanagement in the data. Also, I think that people don't plan.
Yeah. I think that's what it boils down to is like you have to know what you're actually able to spend. You can't just kind of keep spending what you are spending and hope for the best.
Yeah.
That doesn't really work out
And
over a long time period.
it's, the unemployment's low, but it's a competitive job market. I think even when you're older, there's still age discrimination. It's something that people don't really talk about.
Yeah.
You can get fired and maybe sue somebody. It doesn't mean that they have to hire you. Anybody
Mhm.
has to hire you. So that's
Right.
still age discrimination is still out there.
Exactly.
So if you're 55 to 60, 65 for sure, and you're trying to go get a job earning what you earned a few years prior
Yeah.
or 10 years prior, because you didn't work long enough.
Yeah.
It's going to be really hard,
Especially if there's that gap in
unless you're very,
experience.
yeah. And then, yeah.
Yeah.
And do you know anything about AI?
Right.
Right.
Yeah.
So
Yeah.
there's so many things, but let's start breaking that down. So let's define, what is early retirement? What does that really mean?
I guess the most basic way you could define that is just retiring before Social Security age at age 67, which is the full retirement age. Most people kind of in their head, I guess, have age 65, but really, I feel like at our firm, when we're doing planning, it's kind of like if you're retiring in the neighborhood of, basically like pre-60, I feel like that's when it's like, that's kind of early retirement.
Yeah.
But there's not a hard definition. The longer you have to sustain whatever income you have to live on, that's early retirement, especially when we talk about healthcare. So we'll get into the differences, but healthcare is another thing that really is expensive if you retire before Medicare age, which is 65. So those are the two big ones, I would say.
Yeah. And the only exceptions I could think of are military that are on TRICARE, and
Yeah.
then some government and very large companies that offer retiree healthcare at
Yeah.
a pretty low cost.
Yeah.
It's almost like they incentivize you to retire early
Mhm.
from that perspective.
Yeah.
But for the rest of us, it's expensive.
Yeah.
Especially with the ACA credits
Yes.
being changed.
Yep.
Healthcare gets very expensive.
Yeah. So another thing that I guess you could add to this definition is just because somebody says that they're retiring early doesn't mean that they're never going to work again or maybe fully retire. So that's another thing to consider that can help kind of parachute you into retirement if you want to look at it that way. If you're one of our pilot listeners, you obviously know that a lot of guys that have high seniority drop a lot of trips, and then they're flying maybe once a month or something like that. So there's different ways you can do it just depending on your career.
Yeah.
But yeah, so early retirees, kind of, we've already touched on this, but the big risk is just a longer time horizon for you to make whatever savings you have last longer. And then if you're waiting on pension or Social Security, you have to bridge the gap to get to those as well and make a good decision on what options to select there.
I think that's another error people make. They try to take the Social Security early when really they probably have a large enough investments in reserve.
Yeah.
They can spend that down more heavily at the beginning, and then use later pensions and Social Security, and then reduce what they pull out of the portfolio. Sometimes maybe back to zero for a while, so
Yeah.
they kind of recoup over time.
Yeah.
That's something that is really, I think, you work with a lot of clients as their planner, and don't you see that in the meetings where
Yeah.
they're like people tend to segregate it down to just
Right.
Social Security or
Well,
you
yeah,
know what
you're
I'm trying
like,
to say?
I'm looking at a plan and it's, we're talking about this amount, let's just say $80,000. And then they're thinking that Social Security is going to come in and it's going to be on top of that. It's like, no,
Yes.
we're aggregating
Yes.
everything together because we're looking at it comprehensively.
Good planning software will take all the sources, come up with a maximum number, and you're just pulling different amounts out from different buckets at different times.
Right.
But it's the same number going forward plus inflation.
Right.
Yeah.
Yeah.
That's the part that people don't always get.
Yeah.
All right. So let's go through you've written out a few steps here. Know your number. What does that mean? Know your number.
Yeah.
Is that like the Fidelity commercial? Know your number.
Kind of. That's a term you hear a lot thrown around, and I think it doesn't really substitute for planning. So that's what I want to say first. But it is kind of a good back of napkin kind of way to think about retirement, and maybe it can give you an idea of if you're close or not. So the first thing that's really important, this is for, people that feel like, they're ready to retire now. The number one thing I think is understanding what you're spending in retirement, what you're planning to spend, because that really drives everything else. Because if you're not spending in line with what the plan says you can do or whatever, you calculate, then that isn't going to work. If you're overspending, that's just not going to work. So, estimating your annual spending and then also accounting for what's going to change in your lifestyle. So maybe you're spending a lot on, I don't know, sports or for your kids, I don't know, this sort of stuff. Maybe expenses related to work, clothing, budget changes, I don't know. But travel can increase that too. So it's like,
true.
There's
when you stop
different things to
working,
consider.
I find that people actually have spent less money.
Yeah. Yeah.
And I'm not sure what the effect on why that is, other than they seem to just want calm and simple for a little while.
Yeah.
And then after a certain period of time, things definitely ramp back
Yeah.
up.
Yeah. Yeah. Or maybe they get grandkids and then it's like, we're just spending a ton on that, or we're traveling all over the place to go see them. So yeah, there's definitely things that change for sure. And obviously, Casey, you alluded to this already, but some people, when they're doing planning, they don't think about inflation.
Mm-hmm.
You can't just calculate, hey, I'm just going to use the number again, 80,000 into the future indefinitely, because that's probably not going to be a lot in 30 years.
When milk's $30 a gallon, how are you going to afford that on $80,000 a year? Right?
Yeah. Yeah. And obviously over the course of a longer retirement for people that are retiring early, that's just going to be even more compounded. So, and another thing there is like having large one-off expenses in the future. That kind of goes into what we're talking about
new
your
cars,
spending. Right.
New
Roof,
cars, big trip, HVAC.
That's the one.
Ditto.
Yep. But yeah, just kind of have an idea of all of those things.
Understanding your expenses is kind of like part one of our part one.
Right.
And then withdrawal rate, like how much can you actually pull out? And people,
and when you retire as well too.
But how long?
Right.
So how much do I need? How long will I need it? And how much income can I generate during that time period? Yeah. So a lot of people use this thing called the 4% rule, which I think is people only use half of it. Like they don't use the whole thing. Yeah. So they say I can pull out 4% per year and I'll be fine.
Right.
Well, hopefully the market's going up.
Mm-hmm.
But even if the market goes up, it may not go up by enough each year to cover your inflation. So how you're supposed to do that is you would do 4% the first year. The next year you have, let's say it's 2% inflation. You do 4% times 1.02. And I say that very importantly. You don't add 2% to make 6.
Mm-hmm. Yeah.
Right.
Right.
You run out of money really fast this way.
Yeah.
But if you do 4%, add 2% to that. So 4 times 1.02, that's your number. That's what you pull out the next year. And then 1.02 on top of that, whatever the CPI is, consumer price index is for that year. That's how the 4% rule. So you could do that in an Excel spreadsheet and that'd give you an idea of what reasonable income would be from your investments. Then you'd add your Social Security to that.
Yeah.
The safer strategy is to use a 3 to 3.5% withdrawal rate, which I think our software gravitates more toward the lower side. Yeah. It's not quite 4%.
And it's not, I don't think it's calculating everything based off of just the 4% rule. It's kind of showing us that so that we can see what it is being withdrawn. But that's a good point, is like planning software is going to take way more into account than just straight math, because straight math isn't really reality.
It's correct. And life is not linear.
Yeah, exactly.
We just to clarify that point,
yeah,
what our software is doing is using 1,000 different stock market scenarios and coming up with a probability of success. It's not running a 6% rate of return or 7% rate of return. It does a linear one, but then it takes out inflation.
Yeah.
So really your net on our retirement portfolio is showing like 3.5%.
Yeah.
But what we're focused on is the 1,000 different variations, including the really bad ones.
Yeah.
To make sure the plan still works.
Yeah. And your point about the 3 to 3.5% is, and this is something I didn't know. I guess if you looked in our planning software and the kind of like the guts of it, it would actually make sense. But I just had never thought of it this way. Is, if you do retire earlier, the percentage that you would take off your portfolio actually does decrease as you calculate that out. So that's what, if you were to retire, I don't know, really early, then you would actually have to decrease the 4% rule to be in line with that. And that's not something I actually realized until researching for this. But again, if you're doing actual planning, it's not being calculated based off the 4% rule. This is just a good idea to get kind of a number for you.
Correct.
So there's a way that you can calculate it. Basically, if you're doing 4%, you would take your annual spending times 25. And so if that's $100,000 per year, that would be a $2.5 million portfolio using the 4% rule.
Yeah. You're just reversing the math I just did.
Exactly. That's another way to do that. But again, this is just a very simplistic back of napkin kind of number.
Yeah. So same thing. If you needed $400,000 a year in retirement,
Yeah.
you just divide that by 4%.
Right.
Right. And that's your starting point.
Yep.
Back of the napkin math, though.
Yep.
I would not plan on that.
Right.
Like I would not plan on that number. Is that your final number?
Yeah.
Oh yeah. Variability. We need to talk about that for a second. So you're probably not going to pull out the exact same amount of money every single year.
Yeah.
And one of our planning techniques actually is to show travel budgets for 10, 15 years. You're probably not going anywhere in your 90s, maybe
Yeah.
not even your 80s. So let's say we're going to travel or do other things for 10, 15 years, and then we're probably going to cut it out. That
Yeah.
seems reasonable. That allows you to retire on more initially.
Right.
And then, honestly, we do budget for cars and big
Mhm.
expenses, but I would say typically our software is so conservative, the market typically exceeds what we think it's going to do.
Right.
So in that scenario, there creates excess.
Right.
And then with the excess, you get the phone calls. Hey, I want to buy an $80,000 car. We run it through the plan and then say, yeah, just pay cash.
Mm-hmm.
We'll wire the money to you. And that's it. It's
Right.
covered through the plan.
Yeah.
But if you're living on the edge, like you need every single penny, we're really working hard to make this plan work. It's going to be a lot harder to pull that off.
Right.
So live below your means helps.
Yeah. And I mean, that's kind of a key thing of like retiring early, I would say in general, is just making sure that you are living under your means. Cause again, overspending is not going to look good.
Yeah.
If you're retiring a decade earlier than most people.
You got to be living under your means anyway
Yeah.
to retire early because you
Yeah.
have to be a big saver.
That's a good point. Yeah.
I saw, so I'm not doing as much planning anymore because I have rock stars like William and Michaela and Shauna. But in our team meeting yesterday, one came across the table that I saw
Mhm.
that had wanted to retire by 50.
Yeah.
And I'm like, okay, well, this is not going to work.
Yeah.
Like you can't say I don't have any extra cash flow and then say I
Yeah.
want to retire at 50. Like they're going to realize that they're going to have to go to 65, quite honestly.
Yeah.
So you have to have a sense of reality of what's happening.
Before we jump back into the episode, do you know if you are ready to take off and launch into retirement? Get your pre-retirement checklist, a free guide from Wiser Wealth Management. From cash flow to Social Security, we've got your countdown covered. Go to wiserinvestor.com/guides to download your free guide today. Now let's get back to the episode.
Let's go ahead and move to our step 2, build multiple income streams. So
Yeah.
let's talk about that. Sequence of return risk. This is something that I've been seeing a lot in the financial news. I want you to explain that to us.
Yeah. So sequence of return risk is basically trying to explain what would happen if the bottom fell out of the market right as you were trying to retire. That's kind of a simple way to think about it, because if you have no other income, let's say you quit your job and you can't go back right as the market goes down, and that's the portfolio that you are trying to live off of. Basically, you withdrawing money out of that account while the market is down is a risk, because it is harder to recover from that, or you really can't recover from that in the same way that you could if you had either income to live off of or a cash bucket set up off of that you don't actually have to subject that to market risk. So spending off a portfolio that is down is what that's basically describing.
Yeah.
And you don't want to do that.
And then our solution for that is actually creating cash buckets. So
Right.
you should build your cash bucket in good times. We've had, seems like nothing but good times the
Right.
last decade,
Yeah.
but you'd be building this up inside your investment portfolio. It's nothing you have to do outside the portfolio.
Right.
You can do it there, but you don't have to.
Right.
But you build up this cash bucket where you have 2 years of reserve, and your monthly income is coming from that reserve bucket.
Mm-hmm.
And if you have a really bad year, like 2022 was our last big one, you wouldn't pull money from the portfolio side. You'd pull it from the reserve side.
Yeah.
And then when the market rebounded in 23, we simply took those gains and we put it back into the cash reserve.
Yeah.
And built that back up because we had spent that down over a year
Mm-hmm.
in those reserves. That's a case for having an active manager, not active in the sense of buy, sell, but active in the sense of the market's here. We need to replenish our cash.
Yeah.
Market active planner is this
Right.
probably, that's a word. We're
Yeah.
active planners.
Yeah, exactly.
But you want to stay ahead of that inside the portfolio so that your client's not stuck in a position where they're having to liquidate and the market's down 20%.
Yeah. And that's a good point because, a lot of basically all the plans we build they're building in a stress test that's testing sequences of return risk.
Yep.
And so we're not giving anybody a plan that's saying you can't return if the market's down or you can't retire if the market's down. So all of our clients could retire if the market was down in the year that they were planning to retire. That's what we're planning for. But a lot of people make different decisions when they're in that situation. And so because we're saying that you can do that doesn't mean a lot of people would choose to do that. If you have the option to continue working, a lot of people end up doing that. So that's a good point to think about as well, is just because you say, I'm going to retire this year and then something, out of your control happens, it doesn't mean you have to retire that year.
Correct.
So that's another way to mitigate that.
So you think about different income streams in retirement. People think income streams. This must be real estate and pension and
dividends
Social
is another one
Security.
people think of
But
separately.
Yeah. So I think I just took it right off your sheet. I'm sorry.
Yeah, no, that's okay.
But yeah, so that's I gave you the answer. I thought we were going to expound on that.
No.
But looking at income stream options, yes, dividends are part of that. I would say I'll put on my investment manager hat. Going to buy dividend stocks, those trade at a tremendous premium. People still do it.
Mm-hmm.
And if you've done it over the last 10 years, you don't have a very good rate of return.
Mm-hmm.
So it's a combination of growth and income,
Yes.
not growth and income from the equities, from the stock.
Right.
Obviously bonds are always going to be income, but you need those growth stocks to keep up with inflation, where I don't know that value stocks have over the last 10 years. That'd be a good Andrew question, but
yeah, probably not. They probably haven't overperformed inflation by as much as growth for sure.
yeah,
Yeah.
obviously.
Yeah, I guess the other point I would make here too is kind of like what we mentioned earlier, like just because you have other income streams doesn't mean that this is separate from your retirement living expense, because like, again, when we do planning, it's like, this is your number that you're spending each year and we're taking everything together. It's not necessarily separate from your plan in that sense.
Yeah.
But it is a good way, like, for example, with real estate, is a good way to hedge against market downturns because you just have that steady income coming in.
Yeah.
And there's tax advantages to some of these as well, like real estate. So those are good to have, but it's not required, I would say.
Yeah. And I don't know, are we going to talk about part-time work? Because that could be an income stream as well.
Yeah, that's
Get
a
out
good
of the
point.
high stress job and do something that you enjoy doing. We actually have a client now that is, he might be listening. Hey, Bob. He cleans carts at the golf course one day a week.
Yeah.
And he gets free golf the rest of the week. I think he does it like on Sundays or something.
Yeah.
He's a cart guy.
Yeah.
Takes the cart, cleans, hoses it down, puts it back up, and they give him free golf.
Yeah, we have another client that they retired up in the mountains. They're building a house actually right now, and their part-time work was just going to work at an apple orchard like 2 days a week. So it's like, they get
That's
to be
cool.
up in the mountains in the fall,
And people are
It's
always
like,
happy at an apple orchard.
Right.
What could go wrong, right?
I know, right? Like rain's the worst thing that you've got going on. Okay.
Right. That's true. Unless you're inside selling to people.
All right, there you go.
That could be it.
Yeah.
All right, let's talk about healthcare. This is the elephant in the room, guys, our listeners, gals. Man, it's so expensive prior to age 65.
Yeah.
There are some techniques that we've been able to keep healthcare costs down for people. First of all, if you're in that situation, are you curious? We'll connect you with Logan Steele. He's our healthcare guy. That's all he does is healthcare. He's not selling any other products.
Yep.
He actually handles the healthcare for our company. Saved me
Yeah.
$50,000 this last year in premiums.
Yeah.
So thank you, Logan.
Yes.
But he's our go-to person for healthcare prior to retirement. He really does a good job of educating our clients on ACA subsidies, things of that nature. But once you kind of walk us through, some of our options prior to 65.
There's definitely, the ACA marketplace with subsidies. That's one. If you're lower income in the sense of how you take distributions, that's one way that we can actually help, because you can actually get subsidies, in that situation. But that depends on how the portfolio is being managed. And so that's one way that we can actually help with that. And we try to take everything in consideration together. So we're not going to, do certain things in the portfolio that are going to make less money than the actual subsidies would make or save for you. So there's some nuance there with that. IRMA's kind of the same discussion where it's like it just depends on your situation, basically, is what I'm trying to say. So, there's other options like health sharing ministries. I don't know if you've ever recommended that for a client.
I've seen people do it, and then they typically leave because they're just concerned that, man, if something really big happens, like they don't have to pay.
Yeah.
So that becomes an issue.
And, there are high deductible health plan options available, with an HSA. So I guess the point of that is if you are saving in a HSA prior to retirement, that's another good way to prepare for this, especially retiring early.
Yeah.
Because you have this huge bucket of tax-free money that you can pull from to help cover these higher health costs.
Stop spending your HSA money. Put your HSA money in the account, leave it alone, and then leave your deductible in there.
Yeah.
But then everything above that, go invest it. Put it in the S&P 500 or something. But don't let it sit there in cash. But don't be spending the account down. Just let it build up.
Yeah. I mean, we say this probably all the time, but the HSA is the only account that has 3 tax advantages. And so it's, you get a deduction for it going in, it gets to grow tax-free, and then you get to take it out tax-free if it has, if it's used for medical expenses. So that's the best way to use that account, is to save it and invest it if you have the appropriate time horizon to do that. So that's another thing there. I mean, the bottom line is, it is just expensive. The healthcare is expensive pre-retirement. So that's just something we can mitigate by planning.
Yeah. Tax strategies. So I would say that this is step 4. If you're going to be retired for a long time and you're going to retire early, so 50, you have a problem in that you can't withdraw even from your 401k at age
55.
55.
The rule of 55, yeah.
So you can do 55, you can do withdrawals, but at age 50, you can't. You need to have money in brokerage accounts.
Yeah.
And then if you do an IRA rollover from your 401k to an IRA, then now it becomes 59.5.
Right.
So don't be coerced into rolling over your 401k to anybody if you think you're going to be retired prior to 59.5 without other resources. If you've got a couple $1 million in a brokerage account, then you're probably going to be fine to go and do the rollover. But if that is your primary source, you need to leave it in your 401k account so you can withdraw money.
Yeah.
It's kind of a pain because 401ks really aren't retirement portfolios. They're really built for growth.
Yeah.
So you're not going to have the best investment options in there.
Yeah.
But you also don't want to pay the 10% penalty.
No, that's a very good point. Another thing here, there's different spending order too. Like Casey just mentioned, brokerage is the main thing we want you building. And I mean, we're telling a lot of our clients that aren't even trying to retire early that they need to be saving to a brokerage account after they've already gotten their other deductions or maxed their other accounts, because it just gives you so much flexibility.
Yeah.
And I think that's what a lot of this is about too. Like I said earlier, it doesn't mean you have to retire early. Just having the option to, for some people, is really good. It makes them happier at work. So just giving yourself flexibility with a brokerage account is a really big boost to your portfolio, I would say.
Think about this for a second. So you're probably a pretty good saver if you want to retire sooner, or you have a business that you're going to liquidate. But think of this. If you are maxing out 401ks, you're doing all that pre-tax, then you start adding money to a brokerage account. That brokerage account becomes very large. So let's say $750,000 or $1 million is in this brokerage account. The allocation that you have for your large cap, your S&P 500, remove that out, create a new account for direct indexing, invest that money in direct indexing. It's the S&P 500. It's just you're the index owner.
Right.
Look at it that way.
Yeah.
And then you get to keep all the tax credits that the ETF companies would normally be keeping for themselves.
Right.
So you generate tax credits, probably about 6% of what that balance is in the S&P. You create maybe over, let's say, 5 years prior to retirement, $1 million, you probably have generated 6% would be on what's in the S&P 500. So probably about $450,000. So let's make it lower than that. Let's say $300,000. You've probably generated over $150,000 worth of tax credits on your Schedule D.
Yeah.
So when you retire, you're pulling money out of the portfolio to live on, but you don't have to pay capital gains tax.
Yep.
But now you have no tax because you have these capital gains credits sitting there. this is how this works if you've planned out well in advance.
Exactly.
And then if you have no income, you have an income stream, but it's
Mhm.
not taxable. You have no income. That's a great opportunity to then go back to those IRAs
Yep.
and convert from IRA to Roth, which you're going to have to wait to do until you're 59 and a half
Right.
to do those conversions. But that's just a kind of a dream scenario if you plan ahead of time to build up the cash that you need to live on, but also reduce your tax liability to something very, very low.
Yeah. No, that's a great point because, I mean, having those tax losses built up over time is huge because you can just live essentially tax free for years.
Yeah.
So
what's the retirement spending order?
yeah, just going through quickly. We obviously keep a cash bucket and then recommend our clients keep cash on the outside, and then we'd be so you pull from there first. Then we would take it from the taxable brokerage, and then we would go on to traditional IRAs or 401ks that are pre-tax. So, and then we usually leave the Roth IRAs or Roth accounts last, just to maximize the tax-free growth on that. So that's kind of generally how those are invested, how we think about withdrawing from those. Another thing that we can do to just help with overall tax burden is asset location. So if you're a managed client here, then what we invest in your overall portfolio is going to be the same, but depending on the account, there's different ways we match the investments with the different types of tax treatment. So that's another thing we can do as well.
So let's talk about our risk. We already talked about sequence of returns.
Yep.
And if you're a wiser client, we're not worried about that because we've already simulated the great financial crisis happening the day you retired. And we want 100% probability that you won't run out of money before age 95 if that were to happen. You might be leaving less money to your beneficiaries, but you can still maintain your lifestyle.
Right.
What else are we concerned about?
Yeah. So, I mean, longevity risk is one we've kind of already touched on, just living a longer period of time without with having a limited income or, no income. So that's one.
I saw this stat today that if you're under the age of 60 today, you have a very, very high chance of making it to age 100.
Yeah.
With modern medicine and things that are coming down.
Yep.
Through development.
Yeah.
How many times do we sit across the table from a client and go, I'm not going to live past 80. My mom and dad didn't live past 78 or my dad was dead at 62 or, whatever. Right. But you're living longer. People, they can literally print like 3D hearts on a 3D printer right now. So
yeah. And that's why we always plan. That's like our default is planning to age 95 for all of our clients. And we have some that are actually like, I have longevity in my family and we push it out a little bit. So it just, it depends on your genetics too. But yeah, I think modern medicine is really going to push the limits of this.
So what that means is when you have a retirement, when you go into retirement, people think, I have to get really conservative. You don't. Yeah. Actually, your money's been kind of sleeping and growing, but now it's awake and it's your lifeline.
Right.
So you can't get grandma, grandpa on us and get down to like all CDs at the local bank.
Yeah.
You're going to be dead in the water in about 10 years.
Yeah.
So you have to keep risk on.
Yep.
I think at a minimum it's 60 stock, 40 bonds, but a lot of families are gravitating now to 70-30.
Yeah.
At the Schwab conference this year, I watched the whole presentation on why 80-20 is the new 60-40.
Yep.
Because the government most likely is going to screw all this up. There's going to be a high inflation.
Yeah.
And maybe you need to be more 80-20 in your portfolio than 60-40.
Yeah. It's
I'd say 60-40 to add some digital assets or 70-30 and add some digital assets to your portfolio. But you could do 80-20. You just have to have enough cash reserve to withstand the volatility of the 80-20.
Exactly. Like, if you as long as you have that significant reserve and then the bond portion is, substantial enough to mitigate a downturn, then I mean, you can invest very aggressively. So lifestyle creep is another thing that I think we've already touched on a little bit. If you're spending outside of the bounds of what your plan allows, over a long time horizon, that's not going to look good. I think I've already said that, but that's another significant risk to retiring early. So
yeah,
I don't know if you have anything to add, but
I think at a wealth management firm, we have the opposite problem. We have people who've been good savers, and I beg them to go do things.
Yeah.
Like if you're 80 years old and you're not moving around as much anymore, maybe you need help getting out of bed. Who knows?
Mm-hmm.
What is it you wish you would have done?
Yeah.
So it's really hard to get good savers to switch and do lifetime trips because they're so expensive.
Right.
We have a client called me yesterday actually, and he's going to he's single, he's in his 70s. and he is headed to Antarctica
Yeah.
by himself
Yeah.
on a cruise. He's like, you told me I should be doing something. I'm gonna go do something.
Yeah. That's awesome.
It's expensive to go to Antarctica, by the way, but you know what? He needs to do it.
yeah.
This is something I guess he's always wanted to do, and
Yeah.
now he's going to go discover, was it South Pole? Is that the South
Yeah.
Pole?
Yeah.
Yes.
Yeah.
He's going to see the bad elves, the South Pole elves.
Yeah.
So, good for him. We have other families that finally have realized that CNN is not representative of the world, that it is
Yeah.
safe to travel. They can go do things.
Yeah.
But it took a long time to get there. We've had other clients I've had to send. This has been a few years ago, but we went to eBay and we bought like a box of old postcards from different random places,
Mhm.
and we mailed it to him with a note that said, pick a place.
Yeah.
Like, you guys have to go do something.
Yeah. Yeah, well,
You
and that's
can't
the thing
sit.
is like if we're doing all this planning and we're managing the portfolios like we are and all this, it's like that's great, but if it's not enabling you to do the things that you really want to do, then like what's the point?
Yeah.
You know, like
Yeah.
you really should. This should basically rest your mind and give you the latitude and the ability to just go do and live your life, do the things you want to do. So
Yeah, I think the part that's harder is the people who are here who are building wealth, but then they're spending too much and trying to rein them back in.
mhm.
Those are always the interesting conversations, but those are typically never the retirees for the
Yeah.
most part.
especially people that
Yeah.
are trying to retire really early too.
Yeah,
you know?
yeah, absolutely.
Yeah.
All right, so let's talk about some action plans for you guys, step by step. Calculate your annual spending, project your retirement budget, kind of best case, worst case scenario. Your retirement budget isn't your bare bones budget. It's all the stuff
Yeah.
you want to do and what that's going to cost.
Yes.
And it's okay to put it in different buckets for different time periods. That's where using software helps figure that out. Determine your withdrawal rate and target number. Identify income streams that you can build now. So that brokerage account, maybe it's getting a rental house paid off so that it's 100% cash flow
Yep.
when you hit retirement.
Yep.
Look at your healthcare plan. That's going to be expensive. Don't go, we'll just take care of it. You need to have a strategy before you hit the exit button
Yep.
on the job. Create a tax strategy. That's what I love about this place is we are all well-versed in tax. Not all of us are CPAs. Some of us are, but you don't have to be CPA to understand tax and estate planning. Those
Yep.
are two different things.
Yep.
We're not doing your company books and doing depreciation. That's what CPAs are for.
Right.
But when it comes to tax planning for retirement, any advisor here is an expert in that. And then stress test it. If a market goes down, you live longer. Can you do it? And the good news is we do all this here.
Yeah.
And we even give you a portal to get to build upon once we're done with the planning. You can
Yep.
go log in and change all this stuff yourself.
Yep.
Which is pretty cool. So now we have a new segment for me. I think Shauna has already done this when she was leading our last podcast, but we have a new section called 3 Questions in 3 Minutes. And what we're doing is we're going to ask this to every guest, but as each team member comes through one time,
Mhm.
we're going to ask you these questions.
All right.
So here we go. Let's wrap up with this one, William. What's a money mistake you're weirdly glad you made?
I had trouble thinking about this, but I think so. I was in college for 2 years before I transferred to UGA. I worked all through that. I worked in high school, all that, right? The first semester that I was at UGA, I decided not to work. And I think that was really great because I ended up making, long-lasting friends and found my wife and all that stuff in that semester. And so that one ended
Okay.
up paying off. I lived off savings there for a little while.
So it wasn't
and
a
coasted, but
You're saying because it's a money mistake because you just say no
I
job
basically
for
spent
me.
all
I'm
my
gonna spend-
savings.
you spent all your
So,
savings.
yeah,
Okay.
having a girlfriend's not cheap. So
No.
no.
Neither is having a wife, but
Yeah, right?
for
So,
most of us anyway. All right, if you could only could only travel to one place, where would you go and who are you taking?
So I thought about this one a lot. I've always wanted to go to like Australia, New Zealand, just on, down under, whatever.
Yeah.
It just seems really like it's a very rugged like scenery, and I think it looks
Yeah.
really beautiful. So that's one thing. One place I'd want to go. Alaska's another.
Yeah.
And I would take my wife probably. So yeah.
I thought you were going to say the Forerunner.
Well, I can't take it over the ocean, so maybe Alaska. But
Wife's a good, safe answer.
Yeah.
What's something you believed strongly 10 years ago that you don't believe anymore?
Well, I thought that I would have more time in the sense of like, I thought that when you grow up, and this is a really dumb idea, so this is a 15-year-old or 16-year-old thinking this, right?
Right.
But I thought that I would have more time to do other things. And I wish somebody that age, I wish I had taken more advantage of those years and not just kind of goofed around.
Yeah.
Yeah. And it's not like
It's hard for anybody to realize that.
Exactly, because your parents try to tell you that, but it's
Right.
it's one of those things where it's like, I could have been doing something,
Right.
Whether it's more productive, I don't know, working on something important to me, I don't know.
We have so many young
But-
people here now. I'm waiting for I don't think anybody's quite young enough, but I'm
Yeah.
waiting for somebody to say Santa Claus.
16's, that would be a little,
Yeah, 16 was a little weird.
little pushing it, but yeah, no. So I don't regret it, obviously, but
Those are
it is,
good answers. Well thought out. Thank you. All right. Well, let's wrap up here. Early retirement is something that's not out of reach. You just have to plan for it. You have to be aggressive. Just like anything in life, you have to make good choices. So when you think about, am I going to go travel now or do I want to travel later? Am I going to spend $400 to go out to eat with my family at a nice restaurants constantly, or am I going to cook at home and put more money in my savings account? Dave Ramsey has a saying, live like no one else today so you can live like no one else tomorrow.
Yeah.
And that applies to early retirement.
Absolutely.
The fire, we haven't talked about fire, but the fire
Yeah.
movement is I think that's probably dying out a little bit. I don't hear about it as much
I
as
don't
more.
either.
I think inflation killed it in 2022, quite honestly.
Yeah.
But a lot of people are like, I want to be done with this rat race and I want to be out of here by 40. Like
Yeah.
that's radical.
Yeah.
And how they do that. So it's not something that's out of reach, and you might find through the planning process that you can't actually do it. I will say that at least in our case, a lot of times we say, okay, you can't retire at 60. It's going to have to be 65. But then the market outperforms our benchmarks. There's more income or there's a little extra money that was saved. And so every year, instead of adding more money to spend at 65, you can simply just reduce the age in which you retire.
Yep.
So there's a plan is never a plan you do once. A plan should be updated on an annual basis.
It's a living document.
It is. And
Yeah.
that's what we do for our assets and our management clients. Those plans are looked at consistently throughout the year. And there are always little changes as we go through them.
Yep.
So don't be discouraged by the fact that it's maybe harder than you think it is. Thank you for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, I want to schedule a consultation to meet with one of our fiduciary financial advisors like William here. You can do so by going to wiserinvestor.com or clicking the link in the episode notes. We'll see you guys again next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.